So we'll continue on the same financial statements topic. Last time we have covered income statement. Now we'll try to get into cash flow statement and see what it's about. So one thing straightforward for the cash flow statement is basically we'll go into the details and understand what it is made of and all. But typically at the core, what cash flow statements calculates or shows is basically how much cash that is coming into the company and going out of the company through various activities in a particular duration of time. So this is the main thing that the cash flow statement is supposed to track. And the reason why there is a need for this sort of a statement is it will help all the stakeholders. Basically, let's say if a company is applying for a loan and all, so these loan people, whoever are crediting, not necessarily bank, someone else can also be there. So they can look at the cash flow statement and see how well the particular company is financially sound or not. So let's say this cash flow statement is a statement that will hint if they are running for bankruptcy or not, if they're running out of their cash reserves or not, if the company has some issues, if they are not able to earn any revenue in the next few years or something, how much cash reserves do they have at the moment matters a lot for them to sustain, right? And right, so these sort of main at the core, it basically conveys how financially sound and healthy a particular company is to the investors and creditors. So this is the main use of cash flow statement. And as I just told, it's mainly tracks all the cash ins and cash outs of a particular company, and they normally categorize these cash in and cash outs into 3 different buckets. So one, they call it as operating activities bucket, second investing activities, and financing activities. These are just they categorize all the cash in and cash out transactions into each of these 3 buckets for better understanding and all. So operating activities, just like as the name suggests, these are activities that are related to operations of a particular company. Let's say in whatever the main operations of that particular company are. Let's say if you are a particular company who is known for a particular type of selling certain products or certain type of service, right? All the cash in and outs that happen to make those operations possible, those will be recorded in the operating statements. And then we have investing activities. So this is basically where companies other cash in and cash out activities, like let's say if you are looking forward to grow or expand your business, right, then you may have to purchase some additional property, additional equipment, or construct some new plants, or sometimes you may want to even sell off some of the existing or unused plants or properties, assets, etc. So these are all both, again, cash in and cash out. Investing doesn't just mean cash out, it can mean both. So right, so all such sorts of activities where you are investing for the future of that particular company, so those cash in and cash out transactions are recorded normally in this bucket. And then there is called as financing bucket. So in the financing bucket, this is basically, it accounts for all the money that is coming from the outside, apart from the investing or operating activities. Let's say if you are taking a loan, short-term debt or long-term debt, so that will be considered as a cash in in your company in that period under the financing bucket. At the same time, if you are repaying certain debt, right, the previous debt that you have taken, that is considered as cash out. If you are giving some dividends to the existing shareholders, that is also considered as cash out. So these are all the activities under the financing activity. So we'll take a look at the sample cash flow statement, and you will get a little bit more sense of what these three buckets are. But before that, before we go into the example, there are a couple of things we need to know about this cash flow statement. So first of all, cash flow statements is, as I told in the previous session, it's not normally intended to look at, I mean, obviously it can be looked at independently, but it often makes more sense when it is looked at and in tandem with both P&L statements and balance sheet statements. Let me explain the reason for that. So there is a concept called, so this cash flow statement can be calculated on two different types of accounting methods. So it's they're very simple actually. They're called accrual basis, and the second approach is called cash basis. The only difference here between accrual basis and cash basis is that, let's say, let me go to an income statement for the time being. Okay, hold on. Okay, I don't have that here. All right. Got it. So accrual basis is basically a way of calculating cash flow statement on the basis of if you've made a sale or not. Let's say if I'm if I'm making sale of 100 products, and for that 100 products, I got the sale value, basically the money for all the 100 products, then there is no problem. But let's say if I've received only the money for 80 products, but the 20 products money worth is pending. I'm yet to be received for that money. So in that case, the accounts receivable element in the assets value will slightly increase, adding the value for those 20 products. So that means your accounts receivable has increased. But unfortunately, what happens to the revenue piece is that revenue will not differ between if you have got the money right during the sale, right after the sale, or if you are getting the money after some time via the accounts receivable path. So revenue will not differentiate between those two elements. But cash flow statement, what it does is, in order to help identify these two different types, these two accounting methods which we have just discussed, they come into play. There is something called as accrual basis. Accrual basis, what it does is basically, it doesn't matter when you get the money. If you have made the sale, then the money worth of that sale is anyway coming to you. So just whenever that sale is made, consider that amount has been received, irrespective of it is received or not. So when you build a cash flow statement on that concept, it's called accrual basis. But the other accounting option is cash basis. So this is completely opposite to that, saying that irrespective of when you made a sale, only consider the money that you have received when you have received it. So even though, so that means in our example, on the accrual basis, if we have made 100 products sale, but we only received 80 products cash, then we'll have to consider all the 100 products worth of money under accrual basis, but only 80 products worth of money under the cash basis. So this is the main difference that typically people use between cash flow statement and accrual and cash approaches. So let me okay, and the other thing that I was talking about is we often use this particular cash flow statement in tandem with P&L statement and balance sheet statement, right? So this is for the following reasons. So let's say, so if you would look at this particular cash flow statement here, let me start from this particular example. Actually, we're looking at the same ExxonMobil Corporation's cash flow statement, and here they have summarized these three buckets. We'll see in detail what elements are present here, but and a net in this particular operating bucket, they have a net cash inflow of $48 billion in 2021. That is in this particular year, and under the investing activities, they have cash outflow of $10 billion. And under the financing activities, they have a cash flow outflow of minus $35 billion. Now let's see what these things constituted of. Now, if you would notice this particular cash flow statement, let me enlarge it if you can. Okay. Yeah, so if you would notice here, we have starting directly the net income that we have made from the profit and loss statement. And from here, we are building on all the different aspects. So first thing, if you would notice the other elements, there is the immediate next element. This is something called as adjustment for non-cash transactions. This is exactly the concept that we just discussed. So what they're trying to do here is in the, hold on just a second. Okay, not this particular element. Okay, got it. Yep. So I missed this particular element. So got it. So this is the net income that they have got from the cash flow statement, but I'm sorry, from the income statement. And these are the elements that they have made cash from the income statement that we can see. So these are all considered as non-cash transactions. But later, if you would notice, there is something called as accounts receivable, inventories, and other current assets, and etc. and all. So the reason that we are accounts receivable is something that we have to get money, but when we are calculating this net income, we have already calculated this accounts receivable. So if you would go to revenue here, as I told, revenue will not differ accounts receivable if money is received now or later. So that means this particular net income, whatever we have got here, is already taking into account the $12 billion accounts receivable that we are yet to receive. So in the cash flow statement, now what they are doing is, since this $23 billion already consists of that accounts receivable, they are now removing it in order to make sure that what is their direct cash basis cash flow statement. So now they are converting this accrued basis cash flow statement to a cash-based cash flow statement by removing these particular elements. The same idea works with some other elements like inventories, other current assets, and accounts and other payables. So this is the link actually between the cash flow statement and the balance sheet and income statement. So typically what they do is, once they have a balance sheet statement, they will look at items like accounts receivable, which is present in balance sheet, and they will see how much if it has increased or decreased. Now here we can see accounts receivable has increased by $12 billion, and now they have to use that increase to reduce to deduct from here in this particular net income to actually get the right cash flow statement. So and likewise for inventories, which come from, I think again assets, there are a couple of other elements. The net income comes from the P&L statement, and so this is how there are multiple links. Likewise, people normally tend to look at cash flow statement along with both P&L and balance sheet statements. And here we can see these are all operating activities, inventories directly related to their operations, other current assets, accounts payable that they have to immediately pay to the suppliers or something like that, or salaries that can also be chance. So these all accounts that are directly related to their operations will be considered under the operating bucket. And immediately after that, we see investing activities. So here typically most of the times money will be going out. The reason, because they normally invest in their own company to make it expand or purchase some additional equipment to increase the production or something like that. So here we can see some of the additions to property and plant, so that they have made either some changes to the existing, or they have added some more properties. And here we can see, so that means that's a cash out element, and they have, we can also see that they have returned, they've got some value cash inside by selling some of the assets, some $3 billion and etc. And we can see immediately the some other activities, similar activities, and the net in the investment bucket, we have a cash flow outflow of $10 billion. Under the operating bucket, we have a cash inflow of $48 billion. And likewise, immediately after that, we have financing bucket. Here is where we are talking about all the additional outside investments that the company have taken, right? Loans or similar sorts of money in and outs. If you would look at this particular elements, we have long-term debt, short-term debt, and again we have dividends, basically money that shareholders receive for both Exxon company shareholders and also the non-controlling shareholders. And likewise, the net here accounts for minus $35 billion. And now we combine all these three groups to get the on that particular year average, the net cash flow as $2.4 billion net inflow. So, and at the beginning of the year, they had something called as previous year, they had $4 billion as their cash reserve. And for that cash reserve, they're adding $2.4 billion additionally to in this year. So their net cash reserve will become a total of $6.8 billion, which is again something that which we match with the cash equivalents in the balance sheet statement. So yeah, so this is some quick elements before we see some comparisons with year on year. There are a couple of other points I'll just point out, and we'll move on to that. So typically, if you would see here, we have a earlier when I was talking about how this cash flow statement is used by investors and creditors to check if a company is financially sound or not. So this particular, the bottom numbers is where they will see and be able to understand. So even though we have seen that in the income statement and all, in 2020 they have made huge losses, almost $22 billion losses, but they were still able to manage to get a positive cash inflow into the company, and we can see their cash reserves have increased constantly from 2019, 2020 and 2021. So this is one thing that normally interests creditors or investors. On the other hand, if you are seeing that the cash reserves are depleting year on year, if it's otherwise some 6,000 to 4 to 3 and all, then you can immediately see that something is wrong, and in a short duration, the company will run out of its cash. So that is one element, and we can all individually look at each of these elements and be able to make our own points as to where the company is spending more money or company is gaining more money in terms of that, and take investors can get more potential information from that as well. Let me see. One more point is, let's say if a particular company, now we are able to see positive cash reserve of $6.8 billion, but it doesn't mean that all the good companies have a positive cash reserve. There are certain cases the cash reserve can be negative, but still the company is still a financially good company. So oftentimes that happens because of this particular bucket called investing activities. So what happens is the most of the cash that they get, they will invest back into the company to make sure that they grow quickly and expand quickly for the future prospects taken into consideration. So often when that happens, your cash reserves or your cash flow statement often results in a negative cash number. So that is one thing that we have to keep in mind. So negative cash flow doesn't necessarily mean that the company is doing bad. So we just have to take a look at the elements and see where that negative cash flow has happened. If it is because of the investment activities to expand the company, then that can have potentially need not necessarily mean bad thing. And so those are a couple of points, and let me quickly see if there are any interesting observations on year-over-year comparisons here. Okay, so if you would notice the previous income statement that we were looking at, one particular element related to short-term debt and long-term debt. Just a second. Yeah. So it's basically the interest expense. While we are looking at it in the last session, we have noticed that in 2020, the interest has been higher normally when compared to other years. And we have came to a conclusion that it could have been because of there might be some increase in short-term debt or something like that, and we can confirm the same with the help of a cash flow statement here. If you would see in 2020, so there is an element called additions to the short-term debt, and typically they add about 10 to 20 billion dollars every year. But in the year 2020, they had to go almost a little more by over $15 billion additionally. So that additional $15 billion may have resulted in that additional interest that they may have to pay. So that is one thing. And apart from that,
yeah, that's the number, 23,186.
Okay, this is the long-term one, right? Okay.
Yeah.
Okay.
So that is the long-term debt, that the company is taking. That is significantly different from the previous and the next year. You see. So
this one and this one, yeah. And the short-term debt is also slightly higher, right? Almost like roughly 80-90%. And let me see if there are any other. Yeah, I think everything else seems pretty much normal to me. Yeah, so if you guys have any questions, feel free to ask, or else we can try to conclude the session.
Typically, when you can you go to that?
Yes, Sina.
So typically, what are the good signs or healthy signs when you look at a cash flow statements for a company? It will be a steady rise in cash flow across years, and especially from the operating activity, that first section. If there's a steady rise across years, that's a good sign. And in terms of the investing activities, when there's a negative investment cash flow, it's a good sign. If there's a positive investment cash flow, then you have to check what did they sell, and because of which they got a positive value. And it is mostly a bad sign if there's a positive value there.
Okay.
Not all the time, but a negative value is more or less most of the times good. Okay, and then the next thing you want to see is what are the different sources of revenue that comes in, and what is the amount of cash equivalents the company has. So cash equivalents are liquid investments that can be quickly turned into cash at a moment's notice. So like investors would like to see a good amount of healthy cash equivalents as well. And in terms of the financing activity, the last section, it should be balanced. So for the different sources of financing the company has, so that is something that you might want to see. So how much is the equity funding, how much is the debt funding, how much of the debt is long-term, short-term, all that kind of stuff. So these are all the different points to look from these three different sections to make sure if the company is doing healthy at a moment's notice. So it'll probably take 2 to 3 minutes for you to assess the statement, these three sections at a quick glance, and then tell if the company is doing well or not. If you want to talk more about it, you might want to delve deeper, but maximum 2 minutes is sufficient. First section, it should be growing across time. Second section, it should be negative. Third section, how is the split in terms of financing activities? So that's the major things to look at. And when you have any questions on any of the numbers, why it has changed, then you delve deeper into notes and all that kind of stuff, or you look at the other lines of the same statement. Yeah, that's where you get more information.
Okay, great. Sina, when you meant assets that are ready to liquidate, can you point any example here in this cash flow statement?
Cash and cash equivalents will typically come from balance sheet.
Okay.
So it will be a part of that. Assets, cash and cash equivalents. So they have they put that together on the first line, right? So then
Yes.
there's notes and accounts receivable. Then there's inventory. So the cash and cash equivalents part, they generally, so that cash equivalent are basically investments. Okay, so it'll go into that specific section of the cash flow statement as well. So when you put your cash into, let's say, some stock or something like that on behalf of the company, then that's investing activity. So you buy investments of another company, and that'll also come there on the cash flow statement.
Okay.
So when there are returns from that investment, then, and because of that, the investment activity numbers are going up, it's becoming positive, that is okay. But on that section, if there is no investment on long term for plant, property, equipment, like things like that, right, then there's something you need to delve deeper into, because the management will typically invest something into the company for it to generate returns on, right? So if there are no investments on long term, then it's going to be a question.
Okay.
So so it's in that cash flow statement, you see the first line is PPE, additions to property, plant and equipment, cash flows from investment activities. That line, the 12,076 is there, no? That line is additions to PPE, and that should be negative.
Okay.
Then proceed. So if that number is positive, that means they are selling the plant, property and equipment.
Yeah.
That's the red sign. Then the next line is proceeds from asset sales and returns of investments, right? So here you need to delve deeper into the notes to understand where did this number come from. Is it because of asset sales, or is it because of returns from investments? So if it is asset sales, then they are redeeming their principal. So basically they have invested on some stock, they sold that stock, right? If it is returns or investments, for the same stock investment, it's the dividends, right? So that is also something you might want to look at, but more or less it is okay, because it is made with the intention of capitalizing on the price rise typically on stocks, and it is okay if there's a big positive number there, but on the first line it should not be a big positive number.
Okay.
That is what you should be doing.
Okay.